What's up, everybody? I think I'm on time. I can't tell. Smile, Max, if I'm on time, because I can't tell because I didn't hear the intro. Okay. What's going on, everybody? This is obviously, we're all getting used to each other. There's guys all over the world producing this show. In the meantime, here we are in the doldrums of summer, the lackluster trade, the no interest in what's going on in the markets right now. And of course, markets continue to go higher, although they're a little bit lower today. But as we take a quick peek at the markets, and we see, gotta get used to my stuff here. As you can see, S&P right on support after breaking out, looking like it wants to work higher. And for those of you who know, we're watching what we call the phase of the markets. As you can see on my chart, there's only a bunch of my drawings on there. There is no indicators, because their indicators, in my opinion, ain't worth anything. You know, as you look at it, you can kind of watch, how we're trading, and the markets came out of consolidation. We're breaking the upside, and once again, they're breaking out of a small pocket of consolidation. Again, if you're trying to fight this market, you're being foolish. You're hurting yourself. If you really have the desire to be short here, then you should probably be out of the market and wait for a better opportunity, because the opportunity right now is really not there. Even if it were to go down, it's not going to go down that fast with any force, because we're watching a market that lacks volatility. Okay. This is the time, if you're an options trader, that you should probably be buying volatility in some way, shape, or form. And, through our shows, we'll go through different strategies to use. Obviously, this is show number 2. Okay. And of course, our objective is to teach and to help you become a better trader, get better information, get a better broker. And of course, the show is sponsored by Tradier, which is by far the best broker in the industry. Because listen, we know one thing for sure. Life comes down to 2 things. One is always money. Okay. And if you can trade for $10 a month on Tradier, why would you pay any more for anybody else? It just doesn't make sense. It's kind of silly to pay somebody else more money to do the same thing that you're doing every day. All right. But so now we'd be looking to buy some volatility, and you can buy volatility by buying diagonals, by buying calendars. You can do double diagonals, double calendars, which we'll explain this all eventually. It's kind of a general market overview and what we're doing and what we're looking for. And as you look at some of the other markets, the Dow, okay, which is again right at resistance, but also trying to break out. Okay. Now, one of the things you want to understand is forever the S&P was way ahead of the Dow. Now the Dow's starting to catch up. So in your opinion, for those of you viewing here, is that bullish or bearish that the Dow is catching up to the S&P as far as movement? What's your opinion? What's your take? I want to make this show also interactive for all of us, because that's how we learn. Okay, so if you're here and you have a comment, you think it's bullish or bearish when the Dow starts to outperform or catch up to the S&P. Okay. And by the way, while you're waiting for that, if you're looking at your screen, on the bottom, there's a subscribe button. Make sure you subscribe to this, so every time I come on, which will be Tuesdays and Thursdays, anybody else, you'll get a notification ahead of time. Okay. Use the subscribe and use the notification as part of Tradier. Okay. This is their YouTube channel. And again, you're going to get great content. So why not be part of it? And then you get the recordings later as well. And certainly feel free to answer any questions. And so since nobody's chatting to me right now, I'll continue on my own. It is bearish when the Dow is catching up to the S&P. Okay. Because typically when the market is at its most bullish format, the Russell and the NASDAQ are going crazy, followed by the S&P. That is because the Russell and the NASDAQ are where more action takes place in a bull market. That's where we'll call it not gambling stocks, but the higher risk trades are in the NASDAQ and in the Russell. Russell is small caps, obviously much more risk, and of course NASDAQ, which has a lot of newer issues and a lot of wild technology stuff. and of course don't have the same weight as some as the S&P stocks. Like, for example, Apple right now would be more like a utility, not a stock. I mean, where's it going? When you think of a stock, you always ask yourself, and I'm looking at my trades on my right. So when I turn my head away from you, see, I'm looking at charts to talk to you here, okay? Or I'm looking at my trades on another screen, okay? But how much could Apple go down on a bad news item? What do you think it could drop? 5%, 6%? Or, versus a small cap or a less type of liquid or a less valued company could move 50% on a news item. And that's kind of what you want to judge when you look at companies that you're trading and you're trying to figure out where do you want to trade. Is Coca-Cola a great company to trade? And my answer would be no, it's not really worth a shit because it's not going anywhere. It just kind of goes sideways. It's an extremely low volatile stock that doesn't have movement where you're going to get some crazy action, right? Pfizer, big drug stock. They're not going to get any wild action. Yes, certainly we get a big up move trending higher or a big down move. It'll move with the market. But overall on its own, big announcements aren't going to really have that much of a dramatic effect. And so that's what you're looking for. And you can always look at the implied volatility in any stock to get the views. But again, if you look at Coke, you can see that it's really gone nowhere, but it's between 60 and 65. And, when Netflix first came out, it used to be much wilder because the implied vol on Netflix when it was first trading was well over 100. Now Netflix is down in the 30s. So, when you look at the volatility or the implied volatility on a security, certainly when it gets too high, it's very hard to trade for a retail trader, that's what we are. We are retail traders. It makes it very hard to trade because you're way overpaying for options. If you take this one thing away, that options are always fairly priced. They're never cheap. They can only be expensive. Okay. And what does that mean? Look, you have a market maker in the middle making a market, which is what I was. I was a market maker. I was making markets on the trading floor, as Lex was, if you ever see Lex on air. But we made markets, okay? And typically, on a normal trading day, depending on the option, but let's say the option was an eighth wide because, we use fractions. And if you don't know what an eighth is, it's 12.5 cents, okay? So that's what, let's say, what was a normal market, a 12.5 cent market. So up and down, it would be 12.5 cents. So options go down because there's no buyers for them. There's no real action for them. So they will drift lower, which when the volatility gets sucked out, options fall in price. So there's no such thing as a cheap option because they're always fairly priced. And if you think that a market maker is going to give anything away, think again. They'll give you ice in the wintertime if you're lucky. Okay. Now, when they go up, okay, and you get a wild market, and the VIX, for example, changes from trading at 14% right now up to 25, all of a sudden, the normal option that was a 12-cent bid offer spread is now 80 cents bid offer spread. So remember, you as a retail trader, you are selling the bid and you're buying the offer. I don't care what you think. I don't care that you put that midpoint. When that order gets filled, you are paying the offer or you are selling the bid. You are never getting a leg up on the market maker. If you remember that trading itself is a competitive business. This is a competition. Those of us here together are friendly competitors right now. Okay. We're not against each other, but we're all trying. If we're all trading Apple, for example, we're all trying to get the best price. We're not all going to get it. If we're all buyers, I might buy it at one price. You may have to pay more for it. And the next person may have to pay more after that. So that is something that you have to remember when you look at these markets. And of course, when volatility falls, it becomes a challenge. And, I always ask the question, and if any of you wants to participate, I know there's a bunch of you here, but not many participating. But what is good? Is low volatility really good? Is really high volatility good, or somewhere in the middle? You know, it's kind of like the three bears. Okay. And if anybody wants to take a stab at answering, please feel free to do so. And while you're doing that, don't forget to subscribe to the channel so that you can get more of this, because we'll be doing a lot of these. I know that there's a lot of shows planned for trading in general, and you get other people's opinions as well. So why not take advantage of it, right? And you can be a part of it. But the best is when volatility is probably somewhere, excuse me, mid-range. Now let's say 20. You know, when I first started trading, the average volatility was like 30. Okay. I started in 1980. So it was about 30, 35. And obviously trading was so much more active. And that will show you the activity. Now, again, a lot of the volatility has been cut down for various reasons. Number one reason is all of these circuit breakers and everything that's been put into the market to slow any wild action. Okay. That is part of it. The breaking away of the true triple witching cycle, right? In the 80s, triple witching meant triple witching. Everything expired, all the options expired on the same day, within an hour of each other. Okay. Versus now, the S&P starts to expire, you know, S&P, Russell, NASDAQ, Dow, they start to expire the Thursday before the Friday of triple witching expiration. The bonds are even before that. In fact, we're in July, so we got another couple months. The bonds are about 3 weeks before that. So the only true expiration comes with the equity options, as everything else is already expired, which takes away the volatility of triple witching. Okay. Now you add into that 24-hour or almost 24-hour a day trading. That relieves some of the volatility because there is no real pent-up energy that takes place when you get there, right? You know, in the old days, okay, you couldn't do anything. So everybody was festering all weekend long if they wanted to get out. And by Monday morning, which is why most big sell-offs start on a Monday, because everybody couldn't wait to get to their broker and sell. There was an old saying on the trading floor. Okay, when the widows and orphans are lining up at their brokers to sell, it's time to buy. Okay, and that is really still the case, but now you got to figure out how they're getting out. You know, we get into this. Every pundit, and believe me, I've been kicked off a lot of shows for telling pundits that they're full of crap. They all have this big thing about this high frequency trading. Does anybody here know what high frequency trading really is? Okay. Does anybody have an idea what true high frequency trading is and what causes that high frequency trading? I'll give you a second to think about it. Okay. Because it's important that you understand. You know, if I ask, usually I'm asking because I'm trying to teach you something at the same time. Okay. So the high frequency is really caused by you, the retail investor. Okay. High frequency trade by its nature is really an electronic market maker. Okay. That's what high frequency traders are. They're electronic market makers. They're not trying to run the market one direction or the other. All they're doing is making a market, okay, that is narrow and where they're trying to capture fractions of a penny on billions of shares of stock. Okay, that's really what it's all about. When it comes to high frequency, if you yourself remember the last time that you panicked in the market, okay, and you were hitting that sell button, how many people across the globe were at the same time hitting their sell button? When you found it time to panic, so did 5 million other people decide to panic. That's what creates the big moves, not the high frequency traders, not the professional models. Can you guys set me up for a quick break here real quick? Put on my special music. Thank you. But again, so when you go to high frequency trading, the true high frequency is created by people that panic. That's where it really comes from. So despite the garbage that you hear on network TV, it's all wrong. Do you know how high frequency trading affects the price of an order for retail? I'll put it this way. Okay. High frequency trading is by far the best thing that ever happened to the retail trader. They're the ones that forced narrower bid offer spreads. They're the ones who forced decimals. Okay. They're the ones that forced decimals to be trading in this market. And that was the decimal trading was basically the end of the market maker like me, because they could make the market so narrow. Plus the fact that the high frequency trading forced the commissions to come down for the retail trader. So you should kiss every high frequency trading company that you know and thank them for saving you so much money, because at the end of the day, as a retail trader, you get no benefit, okay, from worrying about the bid offer spread. Because if you're trying to work the bid offer spread as a retail trader, you'll get creamed anyways. You'll have no chance to make it. As a retail trader, you have to be willing to take extended risk over time. Trying to day trade options in this market in these times is a game for fools. It's very hard to do, virtually impossible to make any real money, because each and every trade you make, you're giving up an edge. You're giving up either the bid and the offer on both sides of the trade. You aren't, as I said, you're never getting the edge when you trade against a market maker, because they have control of the market. Okay, so the high frequency is the best thing that ever happened to the retail traders. Point, pure and simple. Okay. So as we look and we continue to watch and look at some of the other markets, right? So we look at the NASDAQ, okay, and what's the NASDAQ doing? Well, it's right at the top end of resistance. Now, either the NASDAQ, I don't think it's going to fail, but certainly it wouldn't surprise me if the rally stops or stalls up there. This is a daily chart. I mean, we can certainly break it down to a shorter term chart and make it, 15 minutes. Okay, we make it anything we want, right? It's our choice. Okay. But what happens is you get an area that turned out to be somewhat of resistance, okay? And this is now probably somewhat support here in the shorter time frame. And basically you're just consolidating, which means that the strong hands and the weak hands are just changing places every time they hit resistance or support. Is payment for order flow also beneficial to the retail? Well, I mean, you have no idea that it's there. Maybe okay, but does it affect you? You don't pay it. It is paid for by the broker. It's accounted for in your commission fees. Okay, so it doesn't really hurt you one way or the other. It's a non-event for the retail trader. Does that make sense? Is this my man McGee with me? Just out of curiosity. Okay. So at the end of the day, it has no effect to you. Many brokers sell their order flow, or others buy it because, of course, it creates more volume and more action for them just to get things done. But at the end of the day, okay, it's nothing more than part of the cost of doing business, but you don't even feel it because it's encompassed in your commissions to begin with. And of course, if you're with Tradier brokerage, it's $10 a month. So let them account for it, right? That all some people are doing are buying order flow. But at the end of the day, if you're not using market orders and you're using just regular limit orders, then what's the difference to you? You're getting filled at the limit that you want to trade. Right? If you don't understand, say so. Again, anything you don't understand that I say, make sure you let me know and say so, because I can help you and try to explain it in a different way. But that's a simple explanation, right? So now, as we look and go into, these are 4-minute charts. And this is what I do every morning from 9 to 10 Eastern time, approximately. I trade live with my members. Okay. And we're looking for a specific pattern that's going to appear. And we use 4 minutes to find the trade. We use 1 minute to trigger the trade. Okay. Now again, you can use any 2 time frames you want. What you really want though is you want a secondary time frame which is shorter than your frame that you use to find something to trigger either a buy or a sell. Okay. Again, 2 time frames is much more important because what takes, if you're using a 15-minute chart and a 2-minute chart, for example, 15 minutes is a long time when you're looking to make an entry or get into a trade, versus if you can get the 2 minutes to trigger for you faster, okay, and get you in. I mean, again, that doesn't guarantee success, but it guarantees that you're in the trade. Okay. And then of course you need to set your exit point and your stop or whatever, as that becomes also very important as we look. So you have to be aware of what you're looking for and how you're going to trade these markets, okay, and where you're at. So as I look at the markets today, today we made 2 trades, okay, or 3 today this morning, and we ended up making a tiny bit of money, but it's really not very active. It's really a market that I would prefer, given the choice, if I wasn't teaching and when I was a market maker, trading my own money for my own account, which I still trade my own money for my own account, but I now teach. But be pre-teaching, on days like today, I'd already be on the golf course. And that's what I recommend for many, okay, is don't force yourself into these markets when they're like this, because you're watching the proverbial paint dry market. Okay. When volatility is falling and collapsing, it's very hard because they're telling you that the expectation of movement is not going to be there. Okay. Now I'm going to use TOS real quick for those who don't understand. And I use TradingView as my main charting platform. And since I don't have that available right now for options, I'm going to share this with you because, again, I don't have everything set up, but again, eventually I'll be using TradeHawk here with you. But at the end of the day, okay, any stock will tell you what is expected for movement in any period of time. So if I look at like Netflix, as I mentioned earlier, for the next 3 days, Netflix is expecting a move of $12 plus or minus. Now, how do they come up with that $12? Okay, well, pretty simple. Okay, now you may not understand it yet, or you may not know it, but I'll tell you how to do it so that if you don't have a platform that tells you what the expectations are, all you do is you go to the at the money straddle. In this case, you can go to either the 442.50 or the 445. Either one, they're going to be about the same. So we'll go to the 442.50, and we're not going to do this, but we're going to buy the straddle just to put it up. Okay, so I can tell you. So now if I take a look at this, the straddle is trading at $11.53. Okay, so I know that I got to make more than $11.53 in the next 3 days, one way or the other, or I'm going to lose anyways, right? But now I take this number and I multiply it by 1.07, which gives me an expectation of movement of around 1260, 1270. Okay. And that's the actual real movement based on the at the money option. And that's based on the Black-Scholes model, but that is a model that floor traders had to use, okay, to calculate, because we didn't have time to look at charts, to look at everything else, because we had to make a decision, make a market all within fractions of a second. Okay. It's not like I'm here now. I can sit and take my time and look. I didn't have that luxury. So we had to figure out ways to calculate actual true and real value. All right. So now if I look at Netflix, so right now for the end of this week, it's $12. If I go out to this, now here, I'll do it myself. I'll do it manually, even though it's there. Okay, but if I go out to December of 2025, okay, these aren't valid options. I should have known that. Okay, there. Those are valid options. So Netflix in the next 2 years is expected to move about $230 plus or minus. Okay. 230 up or 230 down. That is what the options out in that frame have priced. Okay. So again, do you want to buy a straddle for $205 on a $400 stock? Probably not. Okay. And this is where you start to learn, and you have to start to investigate on your own alternatives to create the similar position of what you're trying to accomplish over the long term. Okay. And if that doesn't make sense, please feel free to ask anything about that. But again, you're determining first what you think is going to happen. You're determining first what you believe to be what's going to happen next. After you've determined where you want to be and how you want to set up, then you have to figure out the best trade to set up. Just buying calls, just buying puts is never, ever the right trade. Okay. Buying single options is really foolish in the big scheme of it, because you're giving up too much of an edge when you can create a similar position for yourself without doing that. Okay. And with reducing your risk dramatically. And I'll give you an example of a couple of positions that I have on myself that I put on yesterday based on certain information. And I will show you the exact trades that I did. Okay. One was in Roku, Romeo Oscar Kilo Uniform. Romeo Oscar Kilo Uniform. Okay. Roku had a gargantuan move on Friday, continued yesterday, and we would call this what is known as a blow-off. So this to me appears like it's a short squeeze, because Roku is a piece of crap stock anyways, but it looks like it was a short squeeze off after earnings, and it has gone straight up. Well, we know a couple of things for sure. Number one, the rate of change in which this has gone up cannot be sustained. It can still go up. And again, I'm not saying it's going down. I am telling you that the rate of change you've seen here from 65 to 97, which is over a 50% move, cannot be sustained for much longer. Okay. So the position that I chose to take here is a short position, but what short did I take? Okay. What I like to do always is to use a call spread or a put spread. In this case, it was a call spread that I sold. Okay. And I'll show you exact trade. I'll give you exact prices so you can kind of get a feel for what I'm talking about. Okay. I sold yesterday let me set this up first, then I can put the prices in. Okay. I sold the 95, and I bought, I don't want a back ratio, and I bought the 80. Okay. Okay. So here's a spread. Okay. Then I want to reverse it this way. Okay. So here's a spread that I can get a 1330 credit. Okay. So I have a maximum risk on this trade of $15. Okay. Minus 1330 that I'm collecting, which is $1.70 maximum risk. Okay. So how do I know if I'm getting a reasonable price or a good price on this option? Okay. Well, as it turns out, at this phase in time, the price that I have it on for is exactly fair. And how do I know that it's exactly fair? Okay. I look at the corresponding put on the side. I look at the 95 put, because what I really created there was ownership of the 95 put. Okay. So if I look at it this way, what's my benefit? Well, today it's probably more beneficial to buy the 95 put, which is the exception to the rule of never buying a naked option. Okay. Max is coming. Who's Max? Oh, Max is coming back. Hi, Max. You're here twice. You're in dimension. You're in the fifth dimension. Anyways, when you look at it, yesterday when I did this same trade, this put was $1 higher. Okay, so I was getting $1 discount to the trade. Now, obviously, in the option world, anything you get extra you have to give up somewhere. So does anybody know what I gave up to put this trade on as a vertical call spread that I sold versus just buying the naked put? Does anybody know what I gave up to do that? And since we haven't learned to be solely overactive yet, or over contribute to what I'm saying here, I will simply just tell you that I gave up the potential for unlimited downside. My maximum victory on this trade can be $13.35. Okay. Versus if you buy the put, it can in theory go to zero. Now again, that's something that you can decide on your own. Is it worth it? But I can certainly, if I wanted to, I could take this as far away as I want. Okay. Here. So now it's $40. I'm getting a $38 credit. So still the same, it's still the same cost. To me, I got more credit here. Okay. But of course, if I go this deep in the money with the short, what is my risk? What is the problem? It's really not risk, but what is the problem if I go that deep in the money? Anybody know? Bueller? Anybody home? Actually, I can see that I'm a little bit delayed, so maybe you'll have questions later as I'm already moving. But what I'm not concerned about it, but what most would be concerned about is early assignment. Okay, now exercise and assignment is no big deal. Okay, as long as it isn't on expiration Friday where you get stuck with one leg, right? If it's during your period, if I actually did get assigned the short stock, and if I didn't have enough capital to hold it as a short stock, then I'd be forced to cover and readjust my trade. Versus if I had enough to cover margin requirements, then I probably would hold on to it. Why? Because what I've now done is I've taken a trade that had $1.70 worth of risk. Okay. I got assigned early, so I still have $1.70 worth of risk because I still own the long call against it. All right. And but now the difference is my profit potential went from 1330 to unlimited because now I'm short the stock and long the call, which is another form of what they call a synthetic put. And what you have to start to learn and realize if you want to trade options is what are the best opportunities for you. Hold on 1 second. I'm learning some new. There we go. You have to learn what is best for you and what strategies are best for you, plus what strategies you can afford to be in, right? You know, if you can't afford to hold on to the stock, okay, then you wouldn't want to go that deep in the money. You'd want to avoid the assignment. Again, it's not a big deal. There is no risk to that point of assignment. But what there is there's margin requirements. Okay. Why did that go back to? Oh, that's because that's behind. Okay, I got it. Okay. So that's what you have to worry about. You know, the margin risk that you're going to have to deal with. Is the broker going to force you out? Okay. What is your margin interest that you're paying? You know, now, when interest rates were, before the Fed got involved in all this crap, interest rates were cheap. Now all of a sudden, interest at 9.25%, 9.5%, not so cheap anymore. So now the interest rate becomes a real part of your overall trading position, because if you're using margin, then you now have to account for the interest rate that you're paying. Okay. What are the chances of a put getting assigned earlier, and what could be the reason if so it happened? The only time options get assigned earlier and for any event is when all the premium has been sucked out of the option. Okay. When there's no more premium, which is why when an option gets deep in the money, okay, it starts to lose its premium. So, for example, let's go to one that has less volatility because this will be very easy to illustrate. Okay, I look at the spiders that expire, and we won't use the ones that expire today. Okay, we use the ones that expire Friday. If I look in the deep in the money put right now, let's say the 450 put, this is almost trading at parity right now. So when an option becomes parity, there's no benefit to somebody holding the short or long option. They're going to exercise their right because there's other plays that you can make once you control the underlying. Okay. Oh, you didn't. I didn't share myself. You did. Thank you. I got guys watching me. Great producers taking care of me. So when I screw up, they're right there to pick me up because I forgot. Anyways, so when you get parity, you're if you're short a parity option, you're a favorite to get exercised or signed. Okay. Now, the real risk you have to worry about is the dividend risk. Okay. That is the hidden risk that nobody thinks about. But know whatever stock that you're shorting, okay, or any trade that you're putting on, make sure you know the dividend date and how much the dividend is. Okay, because you may choose if you're short a call going into a dividend, you could get assigned on your short call, which means that you are now responsible to pay the dividend that is due. Now, sometimes the dividend may not be big enough to worry about. You may have a big enough profit in this stock in your mind. You may be willing to take a chance and pay that dividend because you want to maintain the position or maintain a short position. There's a lot of things to think about, but in general rules and general understanding, the dividend play is one to really watch for. And anytime you have a parity option, okay, there's a high probability that you will get assigned early, whether it be a call or a put. There is no difference one way or the other. But if somebody knows what they're doing and they can grab the edge on one side, knowing they're going to exercise the other side, now they've got a play where they're locking in some profit. Remember, if you're a market maker or somebody with much bigger capital, there are many more things that you can do that give you opportunity. Okay, but if an option is not at parity and it's above and still carrying a premium, anybody who assigns you early, call them up, thank them, say thank you very much for giving me some free cash, because that's all they're doing. If you get assigned early on an option that's carrying premium that has no dividend, then they're just giving away money. It won't happen often. That's exactly why. Okay. But if they do, they're giving you money for nothing. Okay, so thank them when they do that. But again, so understanding, the different types of positions that you can create. Remember, there's probably, 5 million combinations of different options you can use to create. Whether you want to create synthetic stock, whether you want to create a synthetic call, a synthetic put, whether you want to create a long or a short or a neutral position. There's so many different ways that you can combine all these that I'm sure it's in the millions as to number of combinations. Now, do you need to know them all? No. What you need to know is when you put a trade on, what's my risk? Okay, what is my max exposure and how does it get to my max exposure? Do I take a trade that has unlimited exposure? And the answer should be no. Okay. If you take a trade with unlimited exposure, you really should go see a doctor and have your head examined. Okay. Now you're switching me back again. You should really. It's problematic. Okay, because you're exposed, and there's no reason in this business to ever be exposed. Okay. Too many people like to sell puts. Okay, which is fine. Look, I'm not a fan, but that doesn't make me right. However, what does make me right is I can create the same position for a hell of a lot less money, okay, and give you almost the exact same credit that you're collecting and still the opportunity to buy that stock. Wouldn't that make more sense to not take as much exposure, especially with interest rates at 9.5% for margin? I mean, again, I just give you stuff that I believe to be very fair and very on target. Okay. And this is what we have to understand is when I'm teaching you something, I'm not teaching you for my benefit. I'm teaching you for your benefit because too many of you make too many mistakes in the option world that puts you in jeopardy for no reason when you could make this almost the exact same trade with no risk or no exposure. Okay. So, that's something that we want to always keep in mind because, again, the business itself is a step-by-step. Now, something I don't ever talk about, if you want to sell puts, would you do a put credit spread to hedge your risk? And what would the credit be good enough to return? Yeah, because again, here, let's say, for example, a lot of people like to sell puts in Apple. Okay. So let's say we want to sell a put in Apple, and let's say we want to go out to September. Okay. So in Apple, I can sell, let's say the 190 put. It's for $3. Okay, 300, like 335, let's say. So I get a $335 credit, okay, to hold the stock. So in theory, I'm willing to buy the stock at 186.65. Okay, great. But I have to put up $19,000 of margin, okay, versus if I decide, okay, I want to put some short premium on, I'm willing to own the stock, okay, but let me do a vertical instead. So if I go to the 190, let's say 110, I'm getting the same credit within a couple of pennies. But instead of having $19,000 worth of margin, I've got $8,000 worth of margin. So I've cut it in half. And I can certainly even cut it further in half by coming back closer. If I go to the 140, I'm giving up 10 cents, but my margin now is 5,000 versus 19,000. So you tell me which is better. Okay. If you do the math, you'll find out that what I'm telling you is better and a lot less risk than if you go out and do it the other way. Okay. So again, these are things that too many people make too many mistakes trying to do it. Okay. And you don't need to do it. Okay. You don't need to put yourself in that position. I remember it. See that? Look at how good I'm getting, Max. You don't need to put yourself in that position. Okay. There's no point to it. Why bother? For 10 cents less or $10, I reduce my margin requirement by 14,000. I assure you, if you do the math, you'll find out that the $10 I'm giving up is less than the 9.5% margin rate I'm going to have to pay. So, I mean, pretty simple when you think about it, right? I mean, again, when you're trading, you have to think about all the things that go on, all the pitfalls, all the probabilities. Because what are option trading anyways? Option trading is a probability model to begin with. Okay, we're playing a game. Okay? This is no different than playing backgammon, gin, bridge, okay, or poker. These are all mathematical outcomes you're trying to get to. Okay, and if you can get to the right mathematical outcome, it doesn't guarantee victory on that trade, but what it guarantees you is discipline and lack of risk. Okay. You're taking much less risk over time, which means that you'll be making much more profit over time. That is the important part for you to understand. It's not that you're right or wrong on your decision. What do I care? Whatever side you want to be on, great. But why not get to the side you want to be on with the highest probability and the lowest amount of risk trade? Okay. Does that make sense to everybody? Think about that, right? Why not put myself in a better position? So as we go into the rest of the week, today we had ISM services. Today was ISM manufacturing. There's ISM services this week. There's jobs Friday this week. There's a bunch of earnings. You got Apple and Amazon among many on Thursday. Markets are extremely slow. Okay. It's a very, very tough trade right now. Okay. So it is my advice to you to tread very lightly over the next few days. Okay, probably the next few months, but at least the next few days. What we know, when you're up against some major news, okay, it makes more sense to sit back and really try to pinpoint opportunity instead of trying to step out, okay, and hurt yourself. Markets that lack liquidity, markets that lack activity become a much bigger challenge to trade. So remember, you heard it here from old Bubba. Okay, don't put yourself in unnecessary risk because it's not good for you. Okay. And remember to subscribe. Go to the below there and hit that subscribe button. Okay. And put the notifications on. So every time you want to hear me bitch, you can come and see me. But look, the markets have been very tenuous and very tough to trade. And that means, when you have these narrow ranges, like in the S&P, okay, which is hardly moving. Look at this. I mean, there's no volume, there's no activity. It means to you, so it should be a clear message. Relax. There'll be times. Remember, the markets are open 241 days a year. I don't have to get everything done today. I don't have to make a trade today if it's not there for me. Don't give in to the market. Okay. If you give in, it's foolish. Okay. Pick your price. It's when I give out option trades to my members, it's always, oh, can we adjust the price? I said, no. If you adjust price, you've guaranteed yourself every losing trade no matter what. Okay, you get the winners, but you also get all the losers. Versus if you let it sit, you miss some of the losing trades that come. So why chase the market? Don't ever chase the market. It's not good for you. Okay. So I think that, overall, just be careful. And I know that we're ending a few minutes early here, but I'm going to call it a day, Max and Ruben. I think that we've gone through a lot today, and I think we're going to cut it here. So remember, hit the subscribe button below. Okay. And remember that I'll be back Thursday at 11 Eastern. Is that all right, Max? Is that cool? Okay. And I'll be back at 11 Eastern on Thursday. Okay. But if you have other questions, you can always email me at bubba@bubbatrading.com. I will answer them to you personally, but I'll also answer them live on air here. And until Thursday, have a great week. We'll see you then. And just be careful. A lot of stuff coming out and very thin markets, lack of liquidity. We'll see you later, everybody.